I would say you could call it a change of trend. I mean, from my perspective, and you want to call it analysis, I think we have peaked temporarily. I mean, first of all, I said that at gold at 3,500 a couple months back, and I wrote, for our premium service that gold would be doing a trading range throughout the summer and possibly longer. And I also said that during that point in time, it would be good to either trade gold for platinum or silver, or if you wanted to add your positions, add platinum, add silver, and both those metals took off relative to gold. So in other words, gold stayed basically steady state, and both platinum and palladium recently have all shot up. However, I think they have hit that point that gold did a few months back, meaning that they are going to establish a range for a while. I think how long, I don't know yet. I haven't seen enough data, but I would just guess it probably through the end of the summer. For example, we're end of July. August is usually the worst month or best month, depending on how you look at it, for gold. In other words, usually the cyclical low for gold is established in August. So that's another month out. And then September, the old adage, sell in May and come back after Labor Day. That's usually about the third week of September. So I would guess, from historic precedent, we would see probably all four metals move in a trading range from here, probably for a couple months at a minimum. Obviously, something could hit. But most of the news that's favorable to the metals is already kind of put into the price. And I know everyone's thinking there's very little resistance for silver from, 39 up. But hit 39 briefly, and now it's dropped off about $1, he said. So that's it. Sideways is what I expect. Doesn't mean the bull market's over. It's really healthy for markets to consolidate and build another base and move up. I made that comment on another interview recently. What you really don't want is a higher price every day, and then you get into a parabolic move. Those are not sustainable. But if you staircase up, you build a base at 32, then it jumps up to 34, and you build a base there, and then it jumps up to 36, and you build a base there. Of course, that's an idealized base because, they go up and down, but basically speaking, if you look at the charts, that's kind of what it looks like, a stair. And those are pretty stable because you have a base, so then you have a support level, then you move up and you build another support level. That's what I'm looking at. The tariff situation is like playing 21 at Las Vegas. You could keep rolling the dice over and over and coming up with a different number. But on the basis of what you asked me, I think there's a little more stability, a little more reconciling what these tariffs are really going to look like, and a little more solidity to the proposition that, here's what we're going to do, and you could kind of like depend on that. So, I think markets hate instability. They hate the unknown. So even though tariffs might not be suitable to the counterparty that has to pay them, once they are established and consistent and they know what they're going to be for some, time frame, then the market can kind of, take that in and work with it. I think we're at again, that trading range, and that's what I call an indecision pattern. It's kind of equal bulls and equal bears. No one's really winning. The bears win and the market goes down $100. The bulls win and it goes up $100. I'm referring to gold. And that means that just what I said. So what's going to take it to 4,000? When the bulls have to win, there has to be more buying pressure than selling pressure. What would cause that? Well, there's a number of things, but most are out there already. The war situation, Middle East, Ukraine hasn't gone away, flare-ups in Pakistan that have cooled off. So all of those things that are really favorable to an increase in gold prices are already there and pretty well known. So what's going to take it to the next level? And that would probably be something in the financial sphere where we have, let's say another bond auction and no one shows up, as an example, where, yields are actually forced higher because demand is nothing. So to sweeten the deal, prices, the yield gets pushed higher. And that's just an idea. I'm not saying that's going to happen. I'm just giving you an example. But I am still of the mindset that it will get there, but maybe not as easily as we went from the 2000 level, which we finally broke through and hit, 3,500 pretty quickly. I think we're going to need to kind of work this base and then go higher. $500 more is a nice move, but nothing like the $1,500 that we saw from the 2000 level. Eventually, I think we're going to see even higher than 4,000, but I'm writing a report right now, and depending on the overall global economic climate and what happens in the, I would say, non-reality, the stock market indexes. There's a gentleman that most of our viewers would probably be familiar with, Charles Menner. And Menner is very, very bold in his predictions, but he's also very accurate. And for an example, if we went from the high level of the Dow right now down to 5,000, for an example, thought experiment. David, it's never going to happen. I'm not that bold. I don't know the future. And gold made it to 5,000. Well, that would be a very interesting place to contemplate, because many in our peer group talk about the gold to Dow ratio. And when the gold to Dow ratio hits 1, that's a pretty good sign that we've hit a top in the gold market, or conversely, a bottom of the stock market. I'm not saying that's going to happen. What I'm trying to convey, and I want to convey very strongly, is that the price of gold is what most everyone focuses on. But really, you want the value of gold. And this is something that Mike Maloney does very well. He talks about how much of a house do you get for an ounce of gold, how many barrels of oil, how many bushels of wheat, how much of the Dow Jones Industrial Average. And so if you thought about, let's say, a contraction in the economy and the housing prices came down nationwide, we just use the U.S. for an example, let's say 1/3, but gold went up by that $2,000 or $1,500 from 3,500 to 5,000. So you got that increase in gold, and you got a decrease in the housing market, or maybe the bond market, or the stock market, or the automobile market, which is suffering badly. So you have to look at it in terms of, what do I get for that? So it's not always a function of price. That's what we're taught to think, and we think prices all the time. But really, I think a better and more accurate measure is to look at what it buys in terms of other hard assets. People that follow me, whether they're paid members or not, I mean, they look at, some of us that have a pretty good track record for guidance. I wouldn't say, I don't have a crystal ball. I certainly have made some good calls. I've made some errors. But I think that you got to be objective in this business. It's hard because there's so much emotion around money to begin with, let alone sound money and the argument for, truth in the financial system, which is rare. But with all that aside, you have to stay realistic. And, to put a number out there of, 600 or 1,000 or whatever for silver, you can do whatever you want. I'm free market. That's free market thinking. And maybe in terms of how much the currency's depreciated, that would be the real price. But the market knows more than anybody. And yeah, the market is manipulated. It has been proven. But I don't want to go down that path right now. What I want to do is reiterate what you said, Elijah. And that is, what really got me more solidified as I'll call myself a gold bug. I don't really consider myself that, but I'll use that moniker, was The Invisible Crash by James Dines, one of the first books I read on hard money. And what he pointed out was that the stock market keeps making larger and larger numbers, but in terms of gold, it's actually going down. And that's a real eye-opener. And I said that on your father's last time your dad interviewed me. And I really enjoyed speaking that. And he actually wrote me back, said, David, I'm not seeing that. The AI is not telling me that. So I got a chart for him and I sent it to him. I said, well, there you go. There's the proof. But this is part of the manipulation is, it's, I won't say it's mind control, but it's propaganda. Because if you have a constant, gold's a constant, then that measures everything. And a dollar is not a constant. In fact, what is the price of gold? It's just showing you the depreciation of the dollar or the paper currency versus something that is constant, an ounce of gold. And so, again, I'm glad we're having this discussion because I think it's a good fundamental place or a foundational point that people need to kind of redigest, perhaps, speaking for myself, get a better handle on what do I really want to focus on. Do I want to focus on $10,000 gold, or do I want to focus on where is the economy, what does it buy, how valuable is it? Heck, if we're buying houses, as Andy said, for this, a good price vis-a-vis gold, and let's say you could buy 2 houses for that same amount of gold, hey, wake up and see the light. Gold's probably overpriced at that point. Holding, precious metals, something I've advocated since before I began on the internet. But it's part of your portfolio. In other words, that's my specialty. That's what I advocate, and I'll give you the reasons why. But really, if we want to benefit, that paradox of, a win-win situation where your investments are helping you to have a better lifestyle, and at the same time, what you invested in is also helping society with a better lifestyle, or cleaner air, better water, better food, easier way of doing things, better communications, whatever it is. That's the paradox. You can, as a true capitalist, you can benefit yourself and society at large. And that's largely what I want to be on. I want to be on that where we're helping each other with, our, let's say, wise choices with what we invest in.